Welcome, everybody. Welcome, Web3, IOTA, and Shimmer community. We are in the IOTA Discord today for our sadly last DeFi education session with the experts of Bankless Consulting. We talk about DeFi, we talk about risks and red flags in projects. And without further ado, I'll give over to our referent today, which is Gruat. And we are really looking forward to learn something more today.
Excellent. Thank you for the intro. So again, my name is Grud. I'm going to talk about risk frameworks today, and this is hopefully going to help define at least one way to evaluate projects, how to review and do a little bit of research on a project to properly understand what the benefits and possible risks are. I'm going to define risk versus uncertainty, which is an important distinction to make, and knowing the difference between the two and how to try to mitigate both of them if at all possible. You can never mitigate against all risk, but knowing which risks you're undertaking and whether there's any attempt to hedge against them is an important aspect to reviewing crypto projects. So without further ado, let's jump into the presentation. As was mentioned, this is the last presentation in a series, and hopefully everyone's been attending. Some of these items have been touched on in other sessions, and hopefully I can pull it together into a mental framework for you to carry on with you. So what are we covering today? So the first thing we're going to talk about is what is risk versus uncertainty. A lot of people conflate the two, but they're actually very different things. And in order to understand them, we need to properly define them, and then hopefully we can understand how to treat them in a crypto framework for evaluating possible platforms. The second is, well, what should buyers be thinking about now that we have this working definition of risks and uncertainties? How do we measure them, if at all possible, and what do we do when we understand them? And then finally, what are some questions to consider when I'm looking at a project? How do I bring this all together and in a evaluation framework? So again, what I mentioned today is the goal for me, at least, is to try to introduce you to a way to think about a potential investment within a risk-reward framework. So this is not investment advice. This is a mental model that you can use to evaluate not only crypto, but other types of actions in the world. So I'm an economist by background, and so the way that I like to think about things is expected benefits versus expected costs. So a lot of this, for those that are either traditional investors or experienced investors or economists themselves, will find this fairly standard material. So part one, what is risk and what is uncertainty? There is a difference between the two, and the easiest way to think about this is risk is calculable. It's the thing that you can write down and say, well, there's a 25% probability that I moon. There's a 75% probability that it goes to zero, and I can use those expected probabilities to understand what my expected benefit might be. And that's a very simple example, and we can't always put precise numbers on things, but what's important about risk is that I have some idea in terms of what the probability is that an action occurs and what the expected benefit is should that action occur. So in my example, the expected benefit was moon. Let's say it's $1 million payoff. If there's a 25% chance of that happening, then the expected benefit is $250,000. The other side of that equation is, well, there's a 75% chance it goes to zero. So 75% times zero is zero. So the expected benefit of that little toy definition would be $250,000. So in linear terms, for an investment, the expected value is 250,000. It would be irrational for me to invest any more than $250,000 in that investment, given the fact that I wouldn't expect it to pay off that over the long term in a series of repeated experiments. Well, how is that different than uncertainty? Well, uncertainty is the thing that we really can't know. We, we might understand its existence, but there's nothing we can do to place a number on it, either the probability or the cost. So what is the cost that I invest in something and then a meteor hits the company that I invested in, or the team lead gets hit by a bus? Those are things that it's the latter, maybe you can put a number to it, but they're very difficult to know. So uncertainty really is an undefined risk, if I was going to conflate the two. But it's important to know that you have to determine what it is that you do know and you can calculate, and what it is that you don't know. And those things sort of sit to the side for the moment. Any questions so far? Okay. So when we're looking at an opportunity, we need to have a fairly sober assessment of what it is we actually do know and can quantify in terms of risks, and what it is that we can't know and can't quantify. Because there are certain things besides getting hit by a bus or meteors hitting, companies, those sorts of things. There are macro risks that we might need to be aware of. For instance, there might be a regulatory risk that sits down the road that could impact the crypto platform that you're reviewing, and you really have no way to quantify it because you don't know what the legislative outlook looks like. You don't know what the impact of the legislation might be. There are macro risks. For instance, someone randomly starting a war that you didn't expect, and what are those effects going to be on the systematic effects, or the systemic effects going to be on the economy, and how is that going to have a knock-on effect on any investments that you're looking at or any platforms that you're trying to understand. So really we are in, as people that are looking at crypto or making decisions in general, we're at a war with luck. And what we're trying to do is stack the odds in our favor, make sure that we have a sober assessment of the benefits, and mitigate all the risks that we can, as long as that mitigation is economic. And by that, I mean as long as the cost of mitigating that risk or reducing it is less than the benefit that we receive by that mitigation. So, for instance, insurance. If I had $1 million house, I wouldn't pay $1 million for an insurance policy. That doesn't make any sense. I would want to pay some sort of insurance policy that relates to the expected loss of that house in the same way that we discussed before. The other thing to know is that when someone is offering a token, whether it be a utility token or governance token or whatever or an NFT, whatever it may be, that thing that you are considering is a bundle of both rights and liabilities and risks. And you need to at least mentally catalog what that bundle is. What are you getting for it? What are the potential risks that are associated with it, both in terms of changes in value or whatever the benefit may be? As an example, I'm not strictly monetizing all of this. If you like to participate in governance, there may be a governance token out there that doesn't give you anything else except for a voice in a community. And that's a benefit to you. So there's an expected benefit. And on the flip side, there may be, let's say that there's a slashing risk, that if you made a vote, it was a wrong vote, the community in general could slash the quantity of tokens that you have. Those are things that you would want to assess when you're looking at whether or not you should purchase that token and participate in governance in the community. So it's not necessarily a strictly monetary assessment that I'm talking about, but the framework itself is always going to be fairly similar in terms of how you assess it. So in looking at this example token, what are the sorts of questions that we should think about, and how should we approach the problem? So as I mentioned before, you do want to go ahead and either create a mental checklist or even better, start to develop an investment thesis. So sit down in front of your computer or with a notebook, a piece of paper, or an iPad and start creating a list. What are all the things that can go right? What are all the things that can go wrong? And think about things like the getting hit by a bus risk. So all of those little tail risks that you may not think are important could add up because they might have a fairly large effect on the evaluation of the value of that token or that platform. And I would suggest as a community, if this is of interest, that you start developing that checklist together. Because there may be people that have a different view of things that you may not have. For instance, like I said, I'm an economist. I have no idea whether there are risks I have an idea that there are risks associated with loss of community, but I might not know their mechanisms and I might not know their costs. But someone who's a community organizer or someone who helps manage communities on Discord may have some ideas on that and may contribute to the checklist in a way that I might not at all. And that developing that larger set of possible risks that could affect the platform is important. Marketing may be another one. There are people that are very good at marketing and they understand the risks associated with bad marketing. If you have a great product and you're a lousy marketer, then that can affect the value of the platform. And if you don't evaluate those risks, you've got a big hole in your cost benefit evaluation, and it could come to bite you in the rear if those risks actually come to fruition. So listing all of those things out are important. Working with others to try to get as comprehensive a list as possible and also evaluating what the true probabilities are can help you in evaluating the ultimate benefit of the platform and eventually developing what you would have as a subjective valuation of a token price. So what about uncertainty? We've talked about the fact that you can't actually define it either in the probability or on the cost side because that's what actually makes it an uncertainty as opposed to a risk. So what do we do about it? It is a little bit of an exercise in the impossible because it's all the things that can go wrong that you don't actually know about. I mean, you can kind of list a subset of them, but the important part is to try to get as comprehensive a list as you can on obvious ones. You can't know what you can't know, so you're never going to mitigate all risks across life. It's just that's investing, that's life, and so you're never going to be able to eliminate all uncertainty in life, and you're never even going to be able to actually hedge against all risks in life. But knowing as much as you can about those things that are standing out there waiting to destroy the value of a platform are important. The other piece that we can get to is even if you don't know the probability of something and it's an uncertainty, that doesn't mean that you can't, say, insure against it. I might not know what the probability of getting hit by a comet is, but I can get life insurance so that should I get hit by a comet, there's going to be a payoff at least to my family. And that's important because it turns a potential uncertainty into a known value. So a lot of people can use insurance to convert uncertainty into risk because they're offloading that uncertainty onto another party, which is the person that's insuring it. That, I would say, that's a whole host of other things that you have to think about, including whether or not the insurer is going to be able to pay it off, right? If the entire world gets hit by comets, then you don't get your insurance, but then it's probably not that big of a problem because the world doesn't exist. So lots of things to think about in terms of uncertainty, and there's a whole host of knock-on risks that you might want to think about. But the point is if I can list them out, there might be ways that I can mitigate those or convert them into known costs for me.
Can I ask a question?
Absolutely.
Maybe to clarify, let's say how would you say something like, I mean, we have seen a lot of things happening this year. Let's say the whole Luna fiasco thing. So let's say I'm invested in a project that is somehow over the bigger crypto market connected with something that happened with Luna. Yeah, being it that the project was kind of part of the stablecoin thing, or the things that happen now with Circle and all the things. Yeah,
Sure.
even if it was not actually part of the project that I've invested, um, this as a market condition, would it be something that is just something that you say, okay, that's kind of an uncertainty because all capital markets you can have black swan events or things like this, or also, okay, there is an algorithmic stablecoin and we know kind of, or we have a gut feeling that they're not always super secure, even if it's not related to my direct investment. Would this be something that you would really try to calculate as a risk, or would you put it as just an uncertainty that you can't know, but you know kind of there is something something can always happen
Sure.
basically. Yeah.
Yeah, something can always happen, but there are certain, and this gets at the idea that a risk isn't necessarily that you can calculate the probability to the fifth decimal place,
Yeah.
but you have some idea of what the impact may be, and you can also bookend some idea of risk associated with it. Um, there are there are systemic risks and non-systemic risks. And what you're talking about, I would classify as a systemic risk,
Yeah.
which is there's a macro condition that depresses demand for all things. And if I were to evaluate an, a token that at least had some history, um, I would say, well, what is its movement relative to, say, its correlation with Bitcoin, its correlation with Ethereum or some other blue chip token, or its correlation with the total value locked in DeFi, right? We have those numbers and we can see whether or not things are correlated in some fashion. There are more and less sophisticated ways to measure that correlation, but at least what you're trying to do is get an understanding that if the entire market were to drop by 25%, how would that impact your token in particular? Now, if it's a new platform and I don't have any history even to try to do that basic correlation, you can look at comparables, right? There are other projects that are like this project, and how do those act in the face of either large increases or large decreases in the total market cap for DeFi. So there are ways to get your head around these things, so that you at least have some idea of what the relative impact is. So
Great.
that would be and
Yeah.
to your point, on an algorithmic stablecoin, you very much should think about what the vicious cycle risk is associated with that based on the collateral that they have, the volatility of that collateral, and if the entire market were to go down by 25% and all of their collateral would be reduced at the same time, what's the cycle that's going to create? Is there a dampening effect? Do they have any mechanism to reduce volatility as that occurs, or is it going to feed on itself and increase its own volatility and create liquidation cascades? And those things, while you don't know them perfectly, you can at least think through scenarios and you can work out the reasoning of what might occur. So, and it's important that you at least think through those things. In some cases, you may just, flip a coin and make a decision, but at least when you're doing that, it can help you decide whether that really juicy API is for real, or if it's actually just you're the one that someone else is offloading risk to, and you haven't evaluated it properly. So that 100% API or APY rather may be paying for you to take on the risk that we're talking about.
Yeah. Yeah. Great explanation. Mhm.
So what are the benefits? What's the other side of the equation? We've talked a lot about cost, but people invest not because of cost, but because of benefits. So think about what you're buying. We've talked about governance rights. We've talked a little bit about yield. Does it give you any sort of control? Is it simply a JPEG that you really like and want to declare that you own? Or whatever it may be. What's the expected benefit that you get from this? Because ultimately, the value of the project is not going to be measured by the token price itself, but the benefits that are derived from the project. And when we think about price versus the platform's value, knowing that distinction is going to be very important, because there are some things that can affect the price of the token, but not necessarily affect the value of the platform, right? We have a lot of inflationary tokens that are designed to basically reapportion property rights among their token holders. And it doesn't necessarily change how all of those tokens should be valued in sum, but it could very much change the proportion that you control of that sum. So it's important to think through what exactly that token represents and whether or not that token can be sort of diluted away from you in a way that you may not have expected. So number doesn't always go up. We know this, especially in crypto winters. And as I've said, the value, it doesn't equal the token price. Price is what you see, but value is the thing that you're aiming at. You want to look at platforms that create more value than the resources that they consume. That's basically the fundamental equation of where to begin your investigation in terms of whether or not a platform is going to be good or bad. So this could be a green flag if you look at it and you say, wow, this platform is going to create enormous amounts of value and it's very resource efficient. It only has a team of 5 people, or it's a single artist. His name happens to be Beeple, and he's creating some amazing work. And therefore, I believe in Beeple, so I believe in this item that I can acquire that represents somehow either some of his work or some proportion of participating in Beeple as an individual, whatever that may be. On the risk side, what can affect the value of those things? So we've talked a little bit about market risk or systematic risk. So what happens in a business cycle? What happens on the macro side? If the price of Bitcoin gets cut by 2/3, is that going to affect your token? Chances are it might. If you have a stable token, then it doesn't necessarily affect it in terms of dollar-based valuation, but it might actually appreciate, obviously, relative to Bitcoin. Where are the mechanisms and how are those affected by macro environments? What is the political risk? We've touched on that also. There's a lot of regulatory risk going on right now, and I am not an attorney. I am not a lawyer, and I'm not a politician, so I can't tell you what those risks are and how things will turn out. But it's important as an individual for you to consider them, and possibly as a community for you to think through those things and what the impact might be. So that checklist that we talked about earlier, getting individuals to think about things, especially if you have individuals that are domain experts. So there might very well be individuals in this community that are very familiar with politics in the EU and understand the regulatory environment and the recent legislation and could give some thoughts on what the potential impact is on the ultimate value of crypto platforms relative to that regulation in the near future. We recently saw an OFAC, on the U.S. side, an OFAC order and Tornado Cash. That's still kind of working its way through the courts, but that obviously had a big impact on that platform and could also impact other platforms that were relying on the Tornado Cash capabilities to continue their funding. especially if it was in USDC. So those are risks that we might be able to think about. And if we can't define them, then they start, falling into the uncertainty category. But cataloging them is important. You also have non-systematic risks, right? What about smart contract risk? It seems like every day we see that there's an economic exploit or a smart contract exploit. What can you do to help understand those risks? And can you rely on something called the Lindy effect? And basically, it's a way of describing survivorship bias, which is the longer a contract has gone on unexploited, then the more likely it is to continue in the near future unexploited. That doesn't mean it won't be, but that means that the longer it has existed and survived, the longer the probability is that it is likely to continue to survive without exploit. That is also a function of TVL, right? The longer it has existed and the higher its sort of honeypot represents as exploitable value, if it hasn't been exploited yet, it may be that it's obvious no one has found an exploit, and it might be because it's relatively pure. So there are ways that you can think through things when you're evaluating risk. How old is this contract? Is the team experienced? Has the team had contracts that were exploited either in this platform or previous platforms? If there is a team that has had 4 contracts exploited on the same platform, that should give you pause for thought. Even if they reimbursed everyone 100%, if they keep getting exploited, chances are they're going to continue, the probability is high that they would continue getting exploited. And that should fall into your risk equation when you're evaluating a project. Other things that you should think about is whether or not you can set up watchdogs to see if contracts are being upgraded, because contract upgrades reset that Lindy effect. So you need to know about them, and you need to know if there are time locks, for instance. If there's a contract upgrade but a 48-hour window before it takes into effect, maybe you should consider pulling your funds out of that platform and waiting to see what happens. I mean, those are risk mitigation things that you can do that help hedge against risk, but they're non-monetary things that you can do to reduce. There's economic exploit risk, right? If you're looking at a token, can it be shorted? Can someone borrow against the token? And should it fall, create a liquidation cascade as people liquidate those positions and then sell those tokens on the market and drive down the value just because of lack of liquidity? Can you borrow the token itself? And which is basically saying, can you short it? We talked a little bit about unlocks. So what does the vesting schedule look like for the team itself? Do they get unlocks immediately? Do they get them before you do? If it's a bonding token, are you locking your token up more and for a longer period of time than maybe the team or a group of investors? So those kinds of things are items that you should do your research and understand what are the incentives of those that hold tokens, not only yourself, but the team, the investors, and the communities that are participating in these tokens. And are their incentives aligned with you? Business risk. We talked a little bit about the protocol itself, and it's really important. And in fact, this probably should have been at the top of my discussion, but is the protocol expected to create more value than the resources it's using up? So we can talk about value in a number of ways, and we can talk about resources in a number of ways. But fundamentally, if some platform is spending more, and I'm going to put it in monetary terms to make it easy. If I'm spending $1 to make 75 cents, that's not going to work out too well for me. And you need to have a sober assessment of that. Have you looked at the team? Do you know the team? Have you looked at the community? Do they publish a burn rate? Do they have a Dune dashboard that allows you to understand whether the platform is profitable, whether it's approaching profitability, or whether it's continuing to lose money at a faster and faster rate. What does their treasury look like? If there were a sudden reduction in their native token value, are they able to carry on paying the people that they need to pay to create whatever it is that they're creating to see the value that's going to be created down the line, or are they going to be caught in a liquidity crunch and fold? We also talked about allocations between the teams versus the public and other investors. What do the lockups look like? Are people incentivized to dump as quickly as possible and let you hold the bag, so to speak? Are there perverse incentives, or are they aligned with you and what your time frame is for this token? Last one for business risk is, what does the supply look like? Can they mint forever? Is there some sort of minting function that controls the mint? Is it community determined? Is it fixed? Is it deflationary? Those kinds of things are going to determine the proportion of the platform that you may own in the long run. And it's important to assess where you stand and what you have to do, not to own a token, but possibly to maintain your proportion of representation in the platform, which the token may represent. So knowing who has the authority to mint, what are their incentives to release supply, what are their incentives to reduce supply, are going to be important for you when you're looking at a platform and trying to evaluate whether or not the price of that token at its current rate reflects accurately all the expected benefits and risks associated with the platform. What about liquidity risk? What if you buy something and you can't get rid of it for some period of time? Talking about those unlock schedules. Let's say that you've locked your token in for a year, but the VCs that control 75% of the tokens in this, imaginary example, they unlock in 6 months. Do they have any incentives to hold on to the tokens, or are they going to dump them in the market? How is that going to affect your pricing? Will the platform realize its valuation, and will they be able to communicate it to the market prior to that so that other people can see the value of the platform and soak up some of that selling pressure, possible selling pressure? So knowing those schedules relative to your ability to exit is important. And the higher the barriers to exit for you, the higher those risks should probably weigh, because you don't have any ability to get out of your position unless you're using some alternative hedge. So how do we pull this all together? How do we evaluate a project? If it's a project that has yield, what's the API? If it's 115%, I'm sorry, I keep saying API, but APY. If it's 115%, you have to ask yourself why, right? What is the reason that the market would demand so high an APY? And what's going on in the background to justify it? And does that mean that they're offloading risks to you and trying to pay you by incentivizing you to hold on to a token that inflates quite rapidly, at least in your wallet, for some end state down the road where the price basically goes to zero? And there's no such thing as a free lunch. I'm an economist. I like to say that. So when you see something that looks too good to be true, you have to ask yourself, why is it that, and whether it's the market that's wrong or whether you're wrong. A lot of, especially in crypto, because things can be quite complex, there's a lot of interacting parts. And again, to go back to that idea of having a community to help think through things and think about the mechanics of a platform and their tokenomics and how those might interact with each other can help you determine whether the token is actually worth more than its expected value, whether it's priced higher than its expected value or lower. And ultimately, what's the long run equilibrium of the token? and how long you, as a potential holder of that token, want to hold on to it, and whether that time frame is consistent with the ability to realize the value of the platform. So what's the source of value that pays for that yield? Are they simply just minting more tokens, or are they actually creating value, converting that value into native tokens, and then paying you out in yield? So what are the mechanics of it? There's nothing wrong with bootstrapping a project by creating some mechanism to get people to convert into tokens. But ultimately, that bootstrapping is you giving a platform some other item of value in exchange for whatever token it is that or NFT that they're creating, with the expectation that they're going to do something with it that won't destroy your value. So hopefully they're investing in a way that makes sense. They're creating really cool things, whether that's art, strong community, infrastructure, yields, whatever the platform is. But when you're evaluating that project, you should be asking, where's the value being created? And if you can't find it, if it's just a shell game, then that should be a red flag for you. You don't know where the value is, and you don't think there's a high expectation that it's either being achieved now or will be in the future. That should give you pause for thought. And then, how decentralized is the protocol? So just something that we talked about earlier, if it's a governance token, for example, is there a chance that your token amounts could be slashed? Are there other ways that you could be either slashed in terms of, or rebased, or the proportionality of the tokens that you hold can be changed relative to others? So what's going on there? And then what's the inherent token risk? Is it something that represents an asset, or is it something that's, say, a token that's an algorithmic stablecoin that we talked about earlier that can just lose value if it loses peg and goes into a vicious cycle? Is there any sort of economic risk or rebasing risk? And finally, is there a lockup period? The thing that we talked about before. A lot of these questions you've seen before, but I want you to think about them in terms of your risk-reward framework and whether this goes into the uncertainty bucket or the risk bucket. So where might you go to find some answers? And this isn't an exhaustive list, but this is hopefully something that everyone should do. If you're looking at a project and you think it has some potential, you really should get involved with the project itself, at least to the point where you understand the basics. So go to the project page, read the tokenomics section. Almost all, and if they don't have one, that should be a red flag, right? If they can't tell you what they're doing with their tokens and the model that they're using in a fairly defined fashion and who holds them over what period of time, you probably should, that should be red flag number one, and you just walk away. If you want to continue, get invested in their community, figure out where the answers are, talk to the team, see if there's an ability to trust them in some fashion. Who are the team, I guess, or who is the team? Do they have audits? Do they have a track record with previous platforms? Is there something that you can glom onto that says, here's the reputation of the team, absent other evidence, that I can use to reduce the probability of some sort of risk occurring, whether that be a smart contract risk, soft rug, hard rug, those sorts of things. So even if you're not a developer who can read smart contracts, you can at least understand what are the incentives and what is the reputation of the team to hopefully start to book in some of those risks yourself. So like I said, second point, get to know the community. Ask them questions. Answers should be forthcoming. If it's a new project, they should be able to tell you. If it's an existing project, hopefully they've got a lot of people in there that are excited to tell you about it. But if the community is kind of cagey and the team isn't forthcoming and they don't have representatives there that are at least available and kind of pop in, they could be really busy. But hopefully they're having community calls, and those community calls are giving you access to some of the core members who can talk about what's going on. Do they have a roadmap? So if they don't have those things, then again, that's another red flag. There should be transparency. You are participating and you're thinking about investing either time, effort, or resources into this platform. So you need to understand what you're investing in. Mentioned before, Dune Analytics. Do they have a Dune dashboard? Or maybe if it's not a Dune dashboard, they have some dashboard that they've created themselves. So take a look at the dashboard. What are they showing you? Are they giving you the treasury wallets that they control and the resources that are in them? What are the trends? What's the value of the total value of the platform? What's their burn rate? What does the wallet composition look like in terms of centralization of tokens? Do they have three whales that own 80% of the tokens, or are they fairly decentralized? Those are interesting questions that should inform you whether or not there are any specific risks that might be associated with either the treasury, whether the roadmap is matching up with the trajectory of the token and the cash burn, and whether or not there's a few individuals that can tear the whole thing down in a moment's notice if they decide to exit. So this is nothing in particular, but what I'm trying to do here is just take you through GMX as an example. So if you go to gmx.io, they've got a dashboard. It's their own dashboard. It's not a very good picture, but you can go there yourselves. Take a look at what the overview is. What are the tokens that are outstanding? You can look at the total amount of fees that they're generating. So what's the value that's being created in the platform? There's a few other, and this is just a snippet, but there's a few other analytics that you can dig deeper. You can understand the movements over time, plus snapshots in the current moment. And you can use those along with the documents to understand what your expected return would be on, say, some of the tokens that GMX offers. And I'm not going to go into the specific tokenomics because it's fairly complex, and hopefully might have been touched on by some others in this series. But the resources are there if you are interested in GMX to start digging. And you should be able to go to the documents, which are fairly clear, go to the tokenomics and rewards section, understand the mechanics of how value is being redistributed in the platform, and also understand how value is being created and what the roadmap is for future product improvements. All of those things are there. You can go to the Discord, speak to the community, and get questions answered that you may not understand from the documents, or you may not be able to find the data, in particular in the dashboard. There's a lot of times when I just say, hey, where do I find X? And inevitably, in a very good community, either a core member or someone in the community says, oh, here's either the dashboard or here's the Git book source where you can take a look at it. And again, friendly communities are green flags, friendly and transparent communities. If people snub you or they don't, they're acting a little cagey, that should at least give you some pause for thought. So now that I know I've read the information, I've evaluated my risks and benefits, I've taken a look at what is risk versus true uncertainty, and I've got a pretty good idea of the tokenomics. What do I do with all this stuff, right? And what you should be doing is thinking about this in a more formal fashion, which is what's the expected benefit. If I lay out the scenarios of the world and the likelihood that this platform will generate an amazing product that will it'll remove problems, remove headaches for a lot of people, and or create value in some way, then that's a good thing. And then I have to weigh it against all of the potential loss, right? The team, the core team. Is it a team that has a transition plan? Is it a team with a deep bench? Or is it reliant on a single individual who, if they decide they're burnt out and disappear, the whole thing's going to collapse? Are there other risks associated with the token or the model itself that may not necessarily be associated with the team, but could be macro risks. And can I book in the risks around those? And then if you want to get a little bit more sophisticated, you can think about this in terms of the flow of revenue and flow of losses over time and discount those into the present value. I don't want to get into the exact calculation of that, but there's a net present value calculation you can do to be able to weigh it against the cost of the investment, right? So if I do all of these things and I've managed to measure the investment and I bring it forward in what's called using a discount rate, let's say that net present value of that token, according to my calculations, is $10, and the token price is $5. Well, that's a pretty good margin of error that I will. I'm not going to say it's I'm careful to say it because I'm not giving investment advice, but that at least tells you something about the net benefit relative to where the market is evaluating today. So the second question that you probably should ask yourself is there any way I can improve that formula? Are there ways that I can either offload that risk to a third party or uncertainty or hedge against it? And we talked about earlier, there may be things that you just can't evaluate, but if you can offload it for a price, then that's a headache off of your plate, and it's an uncertainty that no longer fits into your calculation, because what you've done is you've converted an uncertainty that can't be quantifiable into a known cost, which is the premium of an insurance premium, and a known benefit, which is the payoff should that uncertain event occur. So I'm not saying that you should go out and buy insurance on everything, but what I am saying is insurance gives you 2 points of information that could be important for you. One is, how are other people evaluating the risk associated with some event occurring in the platform? And so I mentioned this at a previous talk, just in after the talk, but you can go to something like Nexus Mutual. Let's go to the GMX protocol. It says, for a yearly cost of 2.6%, they will write a policy. Well, what does that policy cover? And is it worth the cost? So the policy says they've covered contract bugs, economic attacks, including Oracle failures, and governance attacks. This is sort of the summary terms and conditions. Do read if you were to purchase insurance, read the contract. But the other piece that this is telling you is that a larger group of individuals are willing to take on those risks that you may not be able to quantify, so uncertainties, at the cost of 2.6% per year. And if I can gain a yield of, say, 10%, so what that's doing is shaving, roughly a quarter off of my yield to cover all of those things that I may not understand fully what the costs are or what the expected probability of those events occurring. Those are things that maybe I don't have the skill to evaluate, or they're just truly unknowable. And so something to consider is whether or not that economic cost of the insurance offloads enough risk that this increases the likelihood of your cumulative average growth rate of your investment to be positive. Does insurance in this case grow your investment, or is it priced too high that you're going to lose money on it? And we can go through a simple experiment. We only have 9 minutes left, and I apologize. So I will stop there. I do have a fun little toy experiment to talk about this idea of insurance, but I do want to stop for any questions.
Okay.
So go ahead. I'm going to share my little experiment while questions come.
Okay. One thing I was thinking about all the time, because we know there are smart contracts audits. So let's say there are a lot of audits and there's a lot of things available that try to mitigate this technological risk in things. And
Mhm.
the projects basically pay for this. They put it on their website. They publish this information for potential investors and for everybody to establish some trust in the protocol. Now, what this whole evaluation of risks and economic questions around that, why don't we see basically companies or teams that are good in doing it and putting things out also like an economic audit of a thing? And why
Mhm.
isn't this? I mean, sometimes you see reports by Delphi and things like this, which I think they're just like, yeah, but it's not something that is like a common thing in the space that if I have a project, I would love to get such a report from a competent expert team on my whole system, and I will put it in my website, yeah, because this is basically kind of a prime
Sure.
thing. Why do
Yeah,
you think it's not happening? Yeah.
I, I think a few things. And what you're asking is why isn't there an economic audit to go along with the smart contract audit,
Yeah.
right? And I think I've asked the same question myself, even among those that are participating in this lecture series. Two things. One is I think it's difficult, and so it requires a lot of resources. So the question is whether or not people would be willing to pay
Mhm.
for the value that it would create. And one issue about this, it's twofold. It's a tail risk. So if let's say that I create a report and I say all the economics are perfect. Oh, by the way, there's this really, really small tail risk that is associated with with this project going into a death spiral under these conditions.
Mhm.
And people may not really, they may discount that tail risk. So who's going to buy the report? Is it something that's going to be purchased by the platform itself, like you mentioned, so they're willing to pay for it? And if so, are the people, when they pay for it, is anyone going to care that the good house, the
Yeah.
good crypto seal of approval is sitting there next to the smart audit? It's unclear to me whether or not people will be willing to pay for it. I don't actually know. No one's tried the experiment yet that I know of. I think there's a lot of companies out there that are trying to create insurance markets.
Mhm.
But I agree with you. I haven't seen anyone who creates an economic audit yet.
Yeah.
Um, so in
Yeah.
some ways, I'm not sure that audit is fully possible because of the risk versus there's so much uncertainty
Mhm.
right now that that a lot of those things, if you were to create a quote unquote audit, and you can't put probabilities or costs on some of those items, that it's going to be a little bit difficult to be able to determine whether or not this audit has given a thumbs up or a thumbs down. I mean,
Yeah.
it can give you just a series of possible risks. So here's the litany of things that we have found that could be possible, and just leave it up to you to
Mhm.
to make a decision.
Yeah. Yeah. Okay. See it. Yeah. Yeah. It's a. Yeah. It seems even be much more complex than a smart contract, because the smart contract thing you have more clear facts that you can check and double check, and you can run a code and stuff like this, and you basically see if it fails or not. Here it's a lot
Right.
of thinking through and yeah, putting up probabilities. Yeah.
And there's a lot of those probabilities are going to be subjective
Yeah.
based on your own evaluation of the market.
Mhm. Cool. Thanks a lot. Yeah.
So a couple minutes left. I'm going to put you on the hot seat. I'm going to give you a bet. The bet is we're going to roll a six-sided die. Promise you it's a fair die. If you roll a six, I'll give you 60% of your bet. If you roll anything between a two and from 2 to 5, I'm going to give you 5% of your bet, so you still win. But if you roll a 1, I take half your bet. So the only thing about this is a bit of a squid game. I'm going to make you play for a certain number of rolls. So we're going to do it for 100 runs. So are you going to take that bet?
No. For 100 runs,
And
no.
why? How many runs would you take it for?
Maybe not more than 4 or 5. Because there's a very small probability that I hit the 6, which will give me a nice reward. There is a small probability that I get, what do you say? You say with a 1, I get slashed 50% or something like this?
Yep.
Yeah, and between them, I get basically nothing, or what do I get between 2 and 2
You
and
get 5%.
get 5%? Okay, actually, then it's probably not a bad idea. Yeah, basically thinking a second time, I would say, yeah, why not? Because kind of there's a higher chance that you get a little gain, and hitting the 1 instead of the 6. It seems reasonable to do it 100 times and take some risk on that.
Okay. And I would agree with you that the expected value on this should be positive.
Mm.
But this is a repeated game. And the one thing to know is when you lose capital, that capital can't be used in the future. So
Yeah.
if all you have in this, I didn't actually tell you the second part of the bet, which is you have to bet everything that you own currently.
Mhm.
So this is one lump sum. You play it, you play the game, and you at the end of the game, you get what's left over.
Yeah.
So if we run that bet out, so let's take 120 people that have managed to convince them to take the bet, and we're going to let it run out by 100 dice throws. So when you do that, the mean, the average, you're right. On average, there was $57 made on $1 worth of capital at the beginning, but the median was 0.48. So most people lost money on that bet.
Yeah.
The reason why they lost money is because of the fact that there's what's called sequential risk. So as I play the game, when I lose half my capital, I can't use that capital to bet into the future. So my compound interest rate gets cut by a tremendous amount. If we think about it, even if it's a fairly symmetric game, if I double the money if I get a 6, and I half the money if I get a 1 and 0 in between, even that bet, if you run it out long enough, can end up losing money because of this sequential risk problem. So once you lost the money, it takes a really long time to get it back, because if I lose half, I can't double. I can't get back the money with the same proportional increase.
Yes.
What's interesting about that is there's a way that I can guard against it. So are there any, and I know we're done, but there's something called a Kelly criterion. Are you familiar with that at all?
Nope.
So Claude Shannon and Kelly in information theory developed what's called a Kelly criterion, which is if I can reserve it, and for them it was to understand how to separate signal versus noise, but in the betting world, it's the ability to reserve some of your capital, and that cash is equivalent to insurance because it's buffering those losses.
Mhm.
So if I take the same game, here I'm going to invest 100%. My Kelly criterion is 100, so I should expect to have the same payoff. My median payoff is still going to be, in this case, I'm running it for 1,000 runs. It's going to be about a penny, right? But if I reserve 60% of my capital, and I play exactly the same game, but I'm only betting 40 cents at a time of what my remaining capital is.
Yeah.
Now the median individual gets $286. I've changed the payoff, the expected payoff function, because I've created some way to mitigate against the risk. And it's a really simple example, that shows you, and this is why in poker you typically reserve some of your bank, right? And this is also why people, and as Marcus said, this is what traders do. Why do they do that? Right? It's basically self-insurance. So just something to leave you with. You can either lose everything, or if you're willing to understand that reservation of funds that could otherwise be used for yield, but you're using it to insure against loss, actually increases your payoff. So something to leave everyone with, and we can talk about it in the future, because there are some sophisticated strategies around that, and there's good math associated with why that makes sense. So when you ape in, just know that when you're aping into a game that looks like its expected payoff is greater than 1, but there's sequential risk, that there may be better strategies to do. So that's it.
Really nice little example for the end. Cool. Do we have any short questions in the audience about that? Any comments? Anything, my friends? Everybody's kind of blown away from the content. Thank you a lot.
It was a good job. Good job, guys.
Thank you.
Yeah, absolutely. I really loved it. It's kind of great way of thinking things through. I take a lot of inspiration from that, actually, especially about this using the power of a community, because like I said, I know we have a lot of very intelligent people from a lot of different fields, and especially for our treasury, community treasury, grant things. This is all plays wonderful in the things that we've been working through the last couple of months in evaluating projects, in calculating and estimating risk that might be there or might not be there. Great content for all of us to watch again and read again and think through and put it up into our practical work over the next couple of months. So that was excellent, I would say.
Thank you very much.
Cool. A question: do you have any? I also asked it last time. Do you have any good resources that you would recommend? That basically, yeah, that for further reading, summarizing things. I don't know, link collections. When people want to dig in deeper into this topic, where could they start? What would you recommend? Maybe you can put it in the chat or something like that, because then I can also put it potentially in the YouTube recording for the audience to click through. So if you have anything that you would really recommend people to look into, send it over to me, or if I give it to Marcus or something, then I will be able to add it to the content.
Okay, I can think of 2 resources that I'm trying to think of some that are relatively short and succinct that also can lead you to further reading if it's of interest. So let me curate those and get them to Marcus.
Amazing. Great, everybody. So as I said, this was the last one of our Bankless session. Amazing time we had over the last, I think, 10 weeks or something like that. As I said, Marcus, thanks for putting this all together, putting the exports from Bankless Consulting together. I think we had a great time. You had great sessions with great references, and yeah, I hope for our IOTA community, for the Shimmer community, this was something that really created for some value for you, things to think through, things to keep in mind, things to visit again when you are going to make some decisions in the next couple of months or years in your personal life, in your strategy. Things that cleared up a lot of those stuff that is coming up for us. We are basically in the beginning of our DeFi journey altogether, and I think having such a fundamental package of knowledge presented to us, I hope that this really helped a lot of you to avoid some mistakes, make some better decisions than without this, and use this for the future to really grow into DeFi and build a proper DeFi ecosystem on Shimmer and IOTA together with us, with the foundation and with the community projects. So thanks a lot for all of you to join here. We will have to think about to do some follow-ups or continuation of such things because I think it's a great value for the community. And again, thanks for Bankless Consulting. It was great to have you here. And I believe this was maybe not the last time that we had any one of you here in our community. Until then, thanks a lot, everyone. See you around. I'll upload this whole thing into the IOTA YouTube channel. Should be online in a couple of hours. And I also will add, I have all the presentations from Bankless Consulting, the PDF presentations. I have it in a Google Drive. I'll add the link, and we will also put every video and every document from here in our wiki so that it will be basically available for every one of you over the IOTA wiki. And so that this knowledge stays within the community and of course can also be shared for everybody else. I mean, it's Web3, it should be available and knowledge for all of us to grow. Thanks a lot and see you around in the community. If you have questions, ask in the chat, send me a DM. No problem for that. Bye-bye, everyone.
Thank you.
Right, and